The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So one thing that you probably have figured out if you are an investor of any length of time, and that is that investing is hard work.
As often as people say it's not, it is. It's always difficult. It's never as easy as hey, just get my newsletter and you'll be rich in a week. And even though that's what they say, that's not reality.
Well, we had a lot of enjoyable experiences in the late 90s as we had the major last hurrah leading up to the tech bubble. And
Sure.
Then we had a similar last hurrah post-COVID, where it didn't matter what you did. You threw a dart at the Wall Street Journal, as the saying goes, and everything was working for a brief period of time.
Right.
Since then, there's been much more difficulty and a lot of speed bumps in the way of finding returns without an excessive amount of risk associated with it. And one of the landmark successful investors going down in history, he's already gone down in history, is Charlie Munger, who passed away recently.
Sure.
He's just short of 100 years old.
Almost made 100. Yep.
He has been through an awful lot of markets. In fact, before his partnership with Warren Buffett came to pass, he was a professional money manager. He'd been in the market managing money, and his returns during that period of time are available for people who want to do some history research. Many people say, I just as soon invest with Berkshire Hathaway because look who's running the show. We've got Warren Buffett and Charlie Munger. What more could you ask for besides those two successful long-term investors? Well, there is some secret to their success, which most people today do not want to accept in their own portfolios. That success was based on a high tolerance for significant losses in the market in their portfolio. Even when it was worse than the market, if they were convinced that their process worked, they stayed with the process.
And that's a valuable lesson. Munger, in the Munger partnership, which is the fund that he ran before he joined Berkshire Hathaway, they've got numbers on that from 1962 to 1975. And old Charlie produced a total return of over 1,100%. At the same time, the S&P 500 was up 100%. So he just killed it over the S&P 500. He was wildly successful, but he was significantly more volatile than the S&P. Should we just relight
that's
that thing
certainly
down?
the case, and nobody likes to have big drawdowns in their account. But you go back and take a look at this. One of the really bad markets was the 73-74 market. Bear market. I started to call it a correction. It was a lot more than a correction.
Oh yeah, that was bad news market.
In the 73 market, the S&Ps, the Dow Jones was down 13, S&Ps down 14. Charlie Munger's down almost 32%, twice as much as the market. And what do investors do today? Say, you don't know what you're doing. I'm out of here. I'm going to go find somebody else. So new people come in and say, well, the market's got to be off. It's bound to bounce. So in 74, the market's down 25, the Dow's down 23, and Charlie's down almost 32 again. That's 2 years in a row of being minus 32, if you round the numbers up. And what does he do? Well, that's the way investing goes, and has been quoted as saying, if you can't tolerate a 50% loss in your account, you have no business being in the stock market.
He
That's
says,
pretty hard to swallow today.
it is. He said, hey, it's only going to happen a couple of times a century, 50% losses, which he had in the Munger partnership. He had 50% losses. And his advice is ignore them, keep doing what you're doing, trust the process, and keep moving forward. Don't throw the baby out with the bathwater. Don't change everything you're doing because you're having a bad year. Just keep going. That's what happens in markets. And you need to learn to deal with that. We tolerate downside at Investor Resources. We strive mightily to avoid things like a 50% drawdown. We've never had anything like that because we're willing to take cash positions, and so we're never up 1,000% over 15 years. But the because people just don't want to tolerate losses that large. You don't want to have great returns for 10 years and then lose half of it in a year. It's too much for people to take. But Mr. Munger said that was fine with him, and over time that was fine. The gains far exceeded the losses, and it's an important lesson to remember that that's the reason returns are in the stock market. That's the reason you get paid more for the risk premium is the risk, and if there is no risk, there is no premium. So the only way you're going to get paid more to own stocks is if it's riskier. And that's the nature of the game. And there are those years where your system doesn't sync up with the market. Your process doesn't provide either the downside protection or the upside growth that you're looking for in the particular market that you're in. That doesn't mean you're making bad decisions. That doesn't mean your process is broken. It means you need some more time, probably. If you've already determined over longer periods of time, the process works. You need to stay with it.
Well, he started investing, or at least managing money, back in 1962. So he was in his late 30s, maybe
Right.
early 40s, somewhere in that time frame. I don't know exactly when he was born. I'm backing up the numbers because we know he was almost 100 when he died
It was just
last
about
last
100.
month.
Right, right.
So it wasn't until 76. So he got 62 to 76. You got 13 years here where he was managing money before he joined forces with Warren Buffett. And Warren Buffett and Charlie Munger in the Berkshire Hathaway portfolio are promoted as buy and hold investors, which is far from the truth.
Correct.
If something is working, they hold on to it and they're willing to tolerate large negative years back to back for
Right.
2, 3, 4 years if they believe they made a good investment and hang on to it. That's where the buy and hold comes from. But nobody talks about the drawdowns during the holding period. Prior to that, when they made a lot of decisions that required quick rotation, oops, that's not working. The assumption we made was wrong, and we're out of it. The 6 month portfolio turnover in Berkshire is a lot higher than most people assume when they think of buy and hold. But if you're in your late 30s and early 40s, and as Mr. Munger was, he had another more than half a century to live to work through markets. That's a different perspective because most people today don't really start serious investing until they're in their late 40s and early 50s when the kids leave home.
Right.
That's when they have discretionary money. And
Finally have a dime.
there's a lot of competition for discretionary money. RVs, boats, nice vacations, world travel. Well, then there's college education for the kids. That's a little disruptive.
Keeping the lights on, stuff like that, So
Just minor stuff that comes with
yeah,
raising a family.
yeah.
Those things are difficult. But they managed because they were frugal with their own living expenses. I mean, Warren Buffett, drives an old Cadillac. Well, he could afford a new one, but he doesn't. I mean, it's a function of priority. What am I going to do with my fiscal resources? And even once they got together as a partnership, the Berkshire Hathaway has certainly not been a smooth ride. It would be more like the roller coaster at Coney Island or your favorite advanced theme park with a roller coaster. I mean, there's the other one that comes to mind. I don't remember. I think it's on top of the Venetian Hotel in Las Vegas. One of those
Right.
big hotels has a big roller coaster. You're up in the middle of the skyline, going around these turns, dips and swings, and um, that's a lot like the results, the drawdown results that Berkshire Hathaway has had. Some of them were absolutely stomach churning, and being able to tolerate that is exactly what Mr. Munger claimed was responsible for their ability to generate remarkable returns over time. It's that over time issue that gets all of us.
Sure.
How much,
People, especially,
how much,
especially these days, since COVID and since the advent of being able to trade stocks or anything you want on your phone, people look for success not in years or even months. It's like, how am I doing this afternoon? It's like today, right now, and all of the trading platforms were trying to gamify investing, make it like a video game. And so we're going to play this. We're going to get lots of nice sound effects and great graphics. And we want you to trade a lot. We want you to try to trade 6 times a day. Buffett and Munger used to say they need one good idea a year. That's why they never went back to Manhattan. They didn't want to be in New York City. They said, if you're in New York City, you're going to get 6 new ideas every day. So we need one good new idea a year to make this work. And so you need to slow down, take a look at what's going on, find what looks like the most probable thing that's going to help you out. And then if you make a mistake, move on. And that's the part, like you said, Don, that's the part of Berkshire Hathaway people don't really pay attention to. If there was a year that wasn't doing well and they had 30% turnover, they're fine with that. They don't have a problem. 30, 40% of the portfolio disappears in a year because it just wasn't working out. What they thought was going to be profitable wasn't. And the prospects don't look good for it going forward. You don't hang on to that. You move on and you trust that process. And even in a year when you lost half of everything you invested, you keep going and you keep looking for where the cash is flowing and where it is that you should be. You trust yourself, you trust the process, and you keep applying it with discipline to the market, and it comes back around. But you have to have that time factor to give yourself a chance, because nothing works all the time.
So one of the common mistakes that investors typically make, particularly as they begin their investing process, time period in their life, is to look at historic returns.
Sure.
Morningstar publishes that information. S&P publishes that information. So they look at mutual funds. They say, well, over the past 10 or 20 years or whatever, the average return is X. They say, well, if I got that kind of return every year between now and retirement, that's going to be duck soup. I mean, I'll do everything I want to do. So
right.
If we just take a look at the 13 years that Charlie Munger was managing money before he joined with Berkshire Hathaway, his average return through those 13 years was 33%, just shy of double both the Dow and the S&P. Now, who doesn't want to do that? Double the market returns. So that's an easy for an uninformed investor. That's an easy decision to make. Why would I settle for the S&P at 17 when I could have Charlie Munger at 33 over 13 years? Hey, right. Man, I'm all in. But over the past 40 years with Berkshire Hathaway, they've had drawdowns of 20%, 32%, 34%, 46%, 51%, 22%, and 25%. That's 7 major drawdowns greater than 20%. And they basically said, yeah, let's go back to sleep. That's not the heartfelt reaction that most investors have today.
No, when you're looking in that rearview mirror and you're seeing that huge return over decades of work, you tell yourself you can ignore those, but when you're down 30%, or 40% or pushing 50%. It's hard to say, oh yeah, that's what this feels like. Let's just keep going. But that's what you have to do in the Berkshire Hathaway process to get the return. You have to stay. You have to stay with it. You have to stay in the market and stay with the investments, and then change out the ones that you feel like just don't have a chance to become profitable going forward. But you have to keep the process going, and you have to keep applying it to the market.
So we have a process. It's basically stay with the leaders, and when they quit leading, get rid of them, find the new leaders. And sometimes cash is the leader. And cash is an asset class, and it's an important part of portfolio management. And when things are confusing and everything's just simply going sideways with a lot of volatility, but you're making no progress, sometimes cash or short-term treasury bills may be the best place to be. But it's not a long-term commitment, unlike most asset allocation models are based on a buy and hold lifetime theoretical risk position with no adjustments to what's actually going on in the market. Mr. Munger and Mr. Buffett made adjustments to their portfolio when things weren't working. But when they owned things that they were confident in, they didn't sell them just because they happened to be behind the eight ball for a little while. So even Berkshire Hathaway, with those 7 major market declines, drawdowns greater than 20%, they still managed to average 19% a year, which is better than the stock market. S&P has averaged over that period of time. That average with dividends comes in somewhere, depending on your starting point, somewhere between 8 and 10%. But you end up with decades of going nowhere. The tech bubble, 2000 peak, took 13 years just to get back to even. And think of 2020, the last decade. We ended up going from 2000 for 10 years with virtually a break-even return. And right now, as we move into this next year, with corporate earnings under pressure, the expected gain in the market is still less than the historic average. I looked at it this morning, and the forecasts are, and I think this was from Morgan Stanley, their forecast for this next year is less than 4.5% return on the S&P. So that's the other mistake that individuals make in their forecast plan work, is they assume they're always going to get that 8 to 10 long-term average when they in fact aren't planning on staying for the same long-term time frame.
Makes a big difference, yeah.
So your starting point is important, and when you draw money out of your account can be a significant detriment to your overall achievement of the returns. So we look at the market and classify our strategy as responsive to market conditions. Instead of making predetermined allocations to say financials or to energy or to emerging markets because we want to be diversified, we accept diversification as an important strategy as long as you're diversified into things that are working. Now just think about that. Most diversification strategies say, if it's not working, eventually it will turn around, so quit worrying about it. Don't call me anymore. But your financial plan and your personal emotions are probably going to have a hard time going to sleep when the returns aren't pretty and within your expectations. So what's your selling process? You have a decision-making process. You're doing this yourself, and you have a set of rules. You follow the rules. You tolerate when things aren't working, and instead of writing them down, you take corrective action. Or are you confident in your system that you are a Charlie Munger or a Warren Buffett, and that 50% drawdown is okay with you because you know you made a good investment decision? Even Mr. Munger in his final interview said, investing is hard. It takes intellect, he said, intellect, hard work. He had one other condition, slips my mind off.
Luck.
That was it. Luck.
He's very humble guy. Yep, saying, hey, as hard as we work, without the luck factor, you got nothing. So you're going to have some of those returns just based on right place, right time. Thank you, Lord, because nothing else was really leading you in there. So that's what you have to be able to have and buy into it, because the process puts you there.
So if you don't have a process, you want to talk to us about it, give us a call. Information for contact is on the slide that follows here. And subscribe. We'll have more coming your way.